Welcome to the Business Resource Center's Bite Size Wednesday, quick 30-minute learning opportunities for our borrowers and potential borrowers and small business owners of Vermont. This recording will be available to you on our YouTube channel. And if you had already registered for it, we'll send you the link. Okay, so healthy credit and management for better business. Our business and personal finances are intertwined, if not literally, then certainly emotionally. Not having one or the other under good management causes immense stress for a business owner. And by managing your personal credit and finances, it's a great way towards greater understanding and management for your business finances. One of the things that we talk about is whether or not debt is something that you own or if debt owns you. In other words, how much of a handle do you have on managing your debt, managing your credit, and managing your finances? Our hope for you is at the end of this, you'll have a better understanding of how to manage your debt and your credit, regardless of what your finances currently look like. So just to center us as we talk about things like credit scores, credit, debt, is just a moment to define what these different words mean when we're discussing them today in the workshop. So by credit, for today's purposes in this workshop, we are referring to credit as that financial arrangement of borrowing money with interest. Credit history, from the it's that ongoing documentation of an individual's repayment of debt. So from the first day you open a credit account to the very last, this is being documented. This also includes any debt you were an authorized user for or a co-borrower on. Credit report is the official document. So there's the documentation, which is credit history, but credit report is the official document that captures and showcases your credit history. This is what lenders pull when you are inquiring about a loan and they're checking to see what your credit is as they pull these reports. Three major credit bureaus that do the reporting where lenders pull their information from are Experian, TransUnion, and Equifax. They use information from your report or your credit history, really, to calculate your scores. So every bureau calculates scores differently, and that includes weighing certain information more heavily than others. So you will have 3 different credit scores. They won't all be the same. Many lenders and banks will often take the average or the median of those 3 scores in your report. Which is basically bringing us to the definition of credit score, and that is a calculation based on information in your credit report. So the better your credit history, the better your score. So a little bit more about credit reports and scores. Just as a reminder, your credit reports are available to you as a consumer for free every 12 months or when you are denied credit. We recommend you check your report every single year. You want to check for things like discrepancies, maybe a payment that you might have missed that you'd forgotten about or weren't aware of, etc. By pulling that credit report every year, you are giving yourself an opportunity to understand what's being reported out there. So you can address any, again, discrepancies or any issues that you may not agree with. So those 3 agencies that I mentioned to you before, that's Experian, TransUnion, and Equifax. They use that information to calculate your scores. And when we talk about credit scores, we talk about 2 different kinds. One is FICO, which actually is an acronym for the Fair Isaac Corporation. It's the oldest and original type of scoring system that exists in the United States. Their competitor and a different score system or company that scores is something called Vantage Score. And the two are used by all three of these bureaus. Oh, one last thing to say about the FICO and the Vantage scores. There are several, particularly with FICO, there are several different types, different types of FICO scores. So it might be FICO 2, FICO 5, FICO 9. Lenders do tend to favor certain versions of FICO over others, depending on the type of loans they are making. So for example, a commercial lender might be looking at a FICO 7, an auto loan and a lender might be looking at a FICO 3. So why is it important to have good credit when you're a business owner? So just as one thing to understand, that to obtain a commercial loan as a small business, you do not necessarily need to have good credit. But one of the reasons, so that is not necessarily, doesn't necessarily determine whether or not you can get a loan. That said, having a good credit, in other words, good credit history and a high credit score, makes you less risky to commercial lenders. And certainly you need to have good credit or decent credit in order to obtain other kinds of lending that might be personal, including mortgages and auto. So the reason why, just kind of pulling all this together as a small business owner and whether or not, and how this affects you as a business owner, is that the main thing to understand is that if you can have good credit or fix your credit, you will have a lot more options when it comes to loans and borrowing. In other words, a lot more options to obtain financing or capital. So you need good credit to refinance just in general, like that's to get a personal loan, a credit card with rewards, etc. The second thing is that borrowing just becomes cheaper when you have higher credit scores. So a high credit score generally equates to lower interest rates. Lenders will charge higher interest rates for lower credit scores because you're seen as a risky investment or a risk. And so therefore they raise the interest rates and makes the loan more expensive. Now, generally, for some business owners, they don't necessarily own property. They might need to rent or lease property for their business. When renting or leasing, especially commercial property, and you have a poor credit rating, landlords may not be willing to do business with you. And then overall credit history could affect your insurance rates, specifically with housing insurance, so house insurance as well as auto insurance. And again, if you need a car for your business, that can affect how much money you can borrow or how much you end up spending for a loan if you are purchasing an auto. And the reason, and just a little bit of background on how insurance works, they don't necessarily use your score. They're not really worried whether or not you pay your bills, but what they care about is predicting insurance claims and major losses. So according to the Insurance Information Institute, III, studies show that the better someone manages their money overall, the less likely they are to file a claim, which means they are less of a risk to the insurance company. So it's not necessarily about your credit score, but generally how you manage your money, and fair or not, that's how insurance companies will determine how much they will charge a rate on your insurance for an automobile or a house. And then just generally something that we touched about earlier is that just building solid and good financial habits is a good indicator that you will manage your business finances responsibly. So even though a commercial lender, including us, may not use a score to determine whether or not you can get a loan with us, if you have a poor credit score or spotty and a poor credit history, we may be more concerned. The lender may be more concerned about lending you a large sum of money or just lending you money at all. So we talk about credit scores. What is a good credit score? Again, we have two different systems that calculate your scores using proprietary methods overall. So we don't necessarily know how FICO or Vantage scores calculate the scores, but we do know a few things about them. For FICO, this is something we pulled from NerdWallet. I think it's a great visual, but FICO, they rate credit scores as either fair, good, very good, or exceptional. And here you will see the scores that are considered fair, good, very good, or exceptional. Vantage score is a little bit different. They call their scores based on prime. So subprime, near prime, prime, and super prime. Over here are their scores. So looking at those credit scores, you also need to keep in mind that lenders may have their own standards on what good credit means. So although you may have FICO and Vantage trying to determine that for you, a lender may have their own standard that they're using to decide whether or not they'll grant you that credit or that loan and at what interest rate. So we encourage you to talk to your lender about what they would consider to be good, fair, prime, near prime credit. So what impacts your credit score the most? The two largest impacts always are going to be your payment history and your credit utilization. In other words, how much of your credit are you using, or how much money do you actually owe on your credit? This particular graph here shows that your payment history is weighted by 35% and the amount owed is 30%. So right there, 65% of your score is made up of your payment history and how much you currently owe. These other bits here, types of credit, new credit, credit history. So types of credit is generally looking for a mixture of types of loans. So installment loans, such as like a car or a house, versus credit card debt. Having a nice mix of that can be helpful for your credit score. And your credit history, it literally has to do with how long you've had credit for. So if the first time you opened up a credit card was, or took out a loan was in your mid-20s, and you're now in your mid-40s, your credit history or your score might be lower than a peer of the same age who had opened their first loan or credit card at the age of 18, because their credit history is longer than yours. This is another good reason, because 15% is still can have an impact. This is another reason that if you have good debt, in other words, you opened up a credit card when you were 18, it was $350, and then you've moved on and moved up to opening new credit cards, we'd encourage you to hold on to and keep open that older credit card. So it continues to show up in your credit history and counts towards the length of time that you have had or managed credit. And then new credit, like types of credit, is the least impactful in terms of how many credit requests have you made, how many inquiries were made on your credit report, what we call a hard pull versus a soft pull. It's advised to try to keep those inquiries at 4 or less in any 12-month period in order for it not to have an impact on your score. But types of credit and new credit will generally change your score by 1 or 2 points. And credit history often, and again, it's all proprietary, so don't hold me to this, but generally we see that credit history can affect your score by 2 or 3 or 4, depending on how new or how old your history is. So some of it, what we call our toolbox, are our tools and magic tricks for managing your credit and your credit history. My personal favorite is using a budget and a cash flow tool. So using tools overall, so whether that tool is a spreadsheet, whether that's an app on your phone, whether it's even a back of the envelope budget that you check in on a regular basis, managing your money and getting good with understanding and managing your money is key to managing your credit and keeping your credit history and your credit score healthy. Now, if you have a lot of credit card debt or you have high interest loans, we recommend, and again, keeping in mind that your credit score is deeply impacted by how much you owe. So if you owe a lot of money, generally anything more than, I don't know, 20% of your debt or 30% of your debt, we encourage you to tackle that debt with like an accelerated payment plan. So tackling credit card and high interest loan debt with accelerated payments, there's two methods that we recommend. My favorite happens to be the Snowball method. And generally the way the Snowball and Avalanche method are similar is that you always make minimum payments on all of your debt, all of the time, every time. But any extra funds you have, you put towards one of your debts. So maybe one of your credit cards to accelerate that payment. A Snowball method uses extra funds to pay down the smallest debt first, and then you work your way through. An Avalanche is when you tackle the high interest rate first, and then continue to tackle the next highest interest rate after you've paid off that debt. And we'll go into that just a little bit more in another slide. Regardless of this, though, every time you do pay off one debt, you move that payment to another debt. So you're always paying the same amount every month, but you are slowly accelerating, or you're slowly paying off more of one debt over the others. And then generally another piece of this is you need to pay your bills, and you need to pay them on time. You need to pay them on time every time. And in this case, because you are using a budget and cash flow tool that we highly encourage you to use, you should also be automating your payments whenever it's possible. This way you can make sure that you're meeting your minimums and you do not get reported, because a credit card company, an installment loan, a lender will report you and are required to report whether or not you pay each month. So it's not like they can just turn that off or turn that on or off whenever they like. So it's important for you that you pay your bills on time, you pay them on time every time, and we encourage you to automate those payments whenever possible. Another thing that impacts your credit score is, again, keeping in mind that credit utilization, it has 30% impact on your score. So keep that utilization under 20%, and even better, under 10%. So in other words, let's say you owe $100. Sorry, let's say that you have credit of $100. You do not at any time want to use more than 20% of that credit. So you have $100 in credit available to you. You want to keep, when this specifically refers to credit card debt, you don't want to owe more than $20 at any one time. And even better, it'd be better if it wasn't more than $10. And your score, you will see, will jump up significantly when you keep that credit utilization under 20%, and even more so when you keep it under 10. Now, if you creep up over 20% and even over 30%, it will have a negative impact on your score. And that impact will be quite significant, sometimes 10, 15, 20 points you'll lose. Going back to leaving good debt on your report. So let's say that you've used the Snowball method, you've paid off a bunch of your credit cards. Rather than close all of those credit cards, you might want to, and get that debt off of your credit report. I would recommend that you actually keep that debt on your report so that lenders can see that you've been able to manage debt and manage it well. That helps your credit score, but it also helps your credit history. Lenders like to see that you've managed debt, you've paid things on time, and that they like to see that. They like to see the history. Also recommend that you utilize credit score monitoring. So although you as a consumer can get a free credit report from all three bureaus once a year, getting a credit score is not so easy. Generally, we have to pay for that. But there are some excellent websites and apps out there that do generally free credit score monitoring. If you have a credit card, there's usually something attached to that credit card already. And what those monitoring websites and apps do is they keep an eye on your credit report and history, and using their best, using what they understand about FICO and Vantage Score, will then put together a score for you that you can kind of watch and keep an eye on. So I actually use CreditWise and I use Credit Karma. Both are excellent. They both use different, one uses FICO and one uses Vantage Score. So I have a sense of what my credit score is like with both of those, with those two different scoring systems. And then the last one is just time. If your credit score or your credit history is dotted with problems and issues, even if you have what's called bad credit, if you are consistent in approaching your bills and your debt and your credit, and you start to manage your money better, you pay off your debt, you use a budget and cash flow tool so you always know how much money you have on any given month. You tackle that high interest loan and credit card debt. You pay your bills on time every time, and you are consistent about that, and you keep your credit utilization under 20%. Over time, your credit will improve and your credit score will improve. So you need to utilize all these different tools in order to get your credit under control. And also it just takes time. So if you can be consistent over 3 months, you'll see a jump in your score. If you can then extend that to 6 months, you'll see another jump in your score. If you can extend it to 12 months, 18 months, and 2 years, you will see a significant increase in your score. But again, it takes time and consistency on your part. So just to give you an example of some of the tools that we use in the Business Resource Center with our clients and with our borrowers, this is just a snapshot of it's actually a multi-tab tool that we use, but this is just an example of a finance template where we create a budget over here. So, accounting for everybody's income in the household, putting down what all the potential expenses might be. We create a cash flow. So we input how much money is in the bank and how your income and expenses affect your cash that's sitting in the bank. That pops up here. And then we do it by month. So March, April, May, June, July, and we generally like to have a 12-month outlook or forecast. So that's one tool that we use. This particular, what's called a workbook, a financial workbook or pro forma, also has things like goal setting, which helps you map a way forward, also helps you visualize rewards, and helps you create habits and consistency. I think we mentioned the debt snowball and debt avalanche methods to tackling debt. I, again, personally prefer the snowball effect or snowball method. And I'll just touch on that in a little bit, but we'll actually in the next screen or the next slide, we'll just talk about what avalanche versus snowball does for tackling debt. But this template is available to our clients and borrowers, and we will certainly send you a copy of this if you registered for this workshop. But if you're viewing this and you're interested in getting this, please contact one of our advisors in the BRC. So this is one of our last slides. So avalanche versus snowball method for tackling debt. I thought this was a really great snapshot that I pulled from a gentleman by the name of Avram Byers, who does personal financial coaching online. So over here, he basically puts it out that if you use, he has the debt avalanche and the debt snowball. So the main piece about the debt avalanche is that you are tackling your highest or basically your most expensive debt. So an American Express card, this person owes $8,000 and is paying 19, almost 20% interest on it. And then he's got a Visa, and then LOC stands for line of credit. Line of credit is the lowest interest. So if tackling this in an Avalanche method, your first priority is going to be your most expensive debt, and that's the American Express. For the Snowball method, it's kind of the opposite in that you are not tackling your most expensive debt, but you're tackling what your least amount of debt owed. So in this case, it's the Visa card. This person only owes $3,000 to Visa. And although the interest rate is is lower than the American Express, the priority is the Visa. And the reason why we do this, so here, and then let me show you. If you care about money and saving money, the Avalanche method tends to be appealing because you are overall, over a course of time, saving money by tackling your most expensive debt first. So the difference here is that if you tackled your American Express before tackling your Visa, you would save about $786. In both cases, it's negligible in that it still takes about 4 years and 7 months or 4 years and 9 months to be debt-free by using these two different methods. So the reason, though, that I like the debt snowball method is because it's psychological. Although Avalanche saves you money, it requires an immense amount of discipline. And the snowball method, what I like about that is that it hits you psychologically and that it's satisfying in being able to wipe one of those debts or address some of that debt immediately or very quickly. It's satisfying. And that means that little reward system of having that satisfaction means that for most people, it is much easier to stick to. The other side effect of using the snowball method that I really like, particularly if you have poor credit history or a low credit score, is that as you tackle that debt, you will see your credit score increase more quickly than if you were to use the Avalanche method. And the difference here, just to show you the time, is that within 8 months, you will have paid off 100% one of your debts. Whereas if you use the Avalanche method for this particular person, it would take this person 2 years and 1 month to realize 100% debt-free by approaching the most expensive debt first. So this particular thing, again, super satisfying to knock $3,000 and one credit card completely off of your plate, and is motivating for you to be able to then tackle the next one. Okay, so this is it. That's it. Financial roadmap to well-being is kind of how I look at managing personal finances, your credit score, and your credit history. By managing those pieces, it really does alleviate anxiety, avoidance. Those are things that are important as a business owner. You need to be able to address. And so when you practice doing that with your own personal finances, it allows you to more easily tackle and deal with the challenges of small business finances, which can be just as, if not more stressful than your personal finances. So that roadmap to well-being, I like to think of handling your finances as self-care. It requires you to look inward. It requires you to take an inventory and understand or have perception about what's really going on in your life, which is so often tied to money. And then it also allows you to build on good habits. And that consistency is so important in being able to improve your credit history, and your financial well-being. Okay. And that's it. So thank you everyone for joining our workshop today. Please feel free to reach out to the Business Resource Center if you have any questions or would like a link to this recording sent to you personally.